Hey there guys, it's Michael Beresford here from OpenCorp for today's Property Wealth WOD. We're back on one of my favourite topics today. I'm super excited. We're talking about finance and specifically finance structure. Apologies for those out there that know that I love to bang on about it. What we're going to be talking about is how do home loans differ from investment loans, or how should they differ to be able to get the maximum benefit. Okay, so this is a masterclass in art as well, if you hadn't noticed. For someone that's been drawing houses for 15 years, I should be better at it, but I'm not. My apologies. So here is one's own home, principal place of residence, okay, with a bit of equity in it and a loan still on that property. And then here's an investment property where the majority of the money has been borrowed, okay, using a bit of equity from the own home to cover the deposit and costs initially. Okay. In essence, okay, the actual loans that you take out for your own home and for investment are not that different, but there's a few key features and functionalities of that loan that you do want to differ if you're going to get it right. Okay, so you still go to the same banks to get them and all that kind of stuff. It's just the kind of features that they have. So typically, this loan is what we call P&I, or principal plus interest. So not only do you pay money back to the bank on a monthly basis to hold that loan, but you're also actually paying it off slowly over time. Now there is a smarter way to do that. Check out the WOD on how to pay your own home off in 10 years and not 30. That's another 7-minute discussion, okay? But check that out. But that's how standard home loans are structured. What we want for the investment loan, however, is that we want it interest only. Now what that means is that you're not paying this principal part, okay? You're just paying the holding costs back to the bank on a monthly basis, which frees up on a typical home loan about $100 a week into your pocket, okay? And you can use that money obviously to hold more property and get the growth on that. So that's the first key difference. Principal and interest versus interest only is how you want to set it up. There's no benefit in using additional cash flow to pay principal down on your own home. On an investment property. Okay. The reason being is if we look at two key points here, cash flow first. Now, what source of cash flow is used to pay the amount back to the bank on principal and interest? Well, it's 100% coming out of your pocket. After tax, okay, you're using post-tax money to pay that. Compared with an interest-only loan where, I was going to write none, because on today's figures, any investment property well chosen would be cash flow neutral at least, okay? But I'm going to say minimal here to be a bit conservative. What that means is that we've got the rental income and then we've got the tax benefits covering most of the holding costs on not only the loan, but all the other things like rates, insurance, and so on, property management. Okay. So that's the key part. The second part is deductibility. Okay. Now, this loan here, okay, none of that is tax deductible. Let me correct that. None. Whereas the interest on here and any equity that's taken, provided that's used for investment purposes as well, is 100% tax deductible. Okay. So this really gets to the key thing that I get asked around offset accounts. Okay. Now for those of you that aren't aware, an offset account is purely an account that is linked to a home loan, whether that's on a principal place of residence or an investment, and it reduces the balance on which you pay interest on. Okay, so simple example, say you've got a $350,000 loan and there's $50,000 sitting in the offset account, your interest is actually only calculated on the difference, being $300K. Okay, so let's look at offset accounts. An offset account makes a lot of sense being linked to your own home because that's reducing the amount of money out of your pocket that's required to hold that loan. What doesn't make any sense is having an offset account linked to this property, okay? Because you want to have your owner-occupied debt as low as possible because there's no deductibility and everything's coming out of your pocket, as opposed to over here where you want to have the higher of the loan amounts, because every dollar is tax deductible, and rent and tax is covering it anyway. Okay, so I hope that clarifies things, guys. The actual loan products themselves, very, very similar. If it suits your circumstances, get an offset account linked to your principal place of residence only. Okay, keep your owner occupied debt low and your investment debt high. Catch you next time.